All right, thank you. So I'm Sadie Raney. I'm the CEO and co-founder of Strix Leviathan, and I'm going to talk to you guys today about treasury management. I'm sure you guys all woke up excited to talk about treasury management because it's such a cool topic. So my husband is a professor here in Barcelona at one of the leading business schools, ESA University. And I live here as well year-round. But back when he was getting his PhD, he was getting his doctorate, whenever we would go to events or parties or social gatherings, we would inevitably run into somebody who would say to us, "Oh, what do you do?" And he would say, "Oh, I'm getting a PhD in accounting." And I would say, "Oh, I'm a financial controller." And we called it the conversation killer. Because guaranteed, they would just kind of look around for a bit, say, "Oh, cool," and then start talking about the weather or a local sports team because we were nerds. So luckily, now we have much cooler jobs, but I feel a little bit like that trying to talk about treasury management at a crypto event, because you walk up, you start talking about crypto, treasury management, and if I were to do that right now, I think people would say something like, "Oh, did you try the paella yesterday?" Because, it's just not that exciting of a topic, but really, truly, it is an important topic, and proper treasury management is gonna be what is going to help this ecosystem in the long run, and a ton of these projects that are struggling to build right now for the long term. I'm really grateful that Avalanche also appreciates treasury management and has put me on this stage here today to talk to everyone about it. Last year at the summit, it was March 2022. Things were going well. I mean, I was in a great mood. I had just sold our startup spin out a company called Makara, which is a robo-advisor for crypto. We had just sold that to Betterment. Things were pretty exciting. Even a year ago exactly today, if you think back, that was, the 4th of May, 2022. My biggest frustration was probably how many more of the "May the 4th be with you" memes was I gonna have to scroll through on Instagram. But hindsight, says that May 5th of last year, things really started to come off the rails. And a week later, May 12th, we watched Luna collapse, and we watched 96% of their value disappear in a single day, which equates to billions of dollars in this industry. And unfortunately, that wasn't that wasn't the last time it was gonna happen last year. We saw multiple events last year which obliterated billions and billions of dollars of value in our ecosystem in just a matter of hours often. So why? Why did that happen? It's not like people sat down and said, well, what's the riskiest thing we can do with our protocol treasury? What should we do with all the money that we're saving? Oh, let's just keep it here and do nothing with it. No, we're running companies. Everyone's out there, they're running companies, they're building, it's a question of priorities. And also, there's the ethos of our space, right? You don't, a year ago, I think I would have gotten booed off stage if I said you need to diversify into traditional assets. I mean, this is an asset class that we're trying to get away from and improve. We're building this ecosystem because the current financial system doesn't serve people well. So, thinking about putting your money into that system, that's really, really hard. But unfortunately, right now, that's a reality. And then there's also a lot of protocols, they have their stuff, their tokens locked up for a reason. It's not just that they're too lazy to do something with it. I mean, there's legitimate reasons why your tokens are locked. And then allocating across the industry. If I'm building my coin, I don't want to take my money and put it in your coin because I believe my coin is better built than your coin, and I don't, maybe your coin is my competitor. I don't really want to give you a bigger treasury, but how do I diversify if I'm not able to allocate to others? So a lot of these decisions are what cause CFOs and financial managers within protocols and companies to sort of become in a catch-22 situation where they don't really have a great option to follow their principles and follow the goals of the company and the space, but also protect the balance sheet and protect your cash flow long term. Everybody wants to be holding their own token when there's a run-up. I mean, today, if I hold certain coins, it can run up 40%, which is great. I don't want to miss out on that. But tomorrow it can crash 60. So, you really have to figure out how much you're willing to risk in order to catch that upside, and how can you protect yourself on that downside. As I mentioned, there's a lot of tokens that you can't do much with. You're just sort of stuck and they're locked in. And there are ways to manage those, but it's not easy. And then bad actors. A lot of people are out there offering to market make for you and manage your treasury, but they're not doing it in your best interest. We've been in this industry for 5.5 years. We've talked to so many protocols and so many projects, and over and over and over, we've heard that they have problems with their market makers. They don't know what their market makers are doing. They're concerned that their market makers are actually trading against them. There's just constant frustration and mistrust, which is why we've started doing market making in a much more trustworthy way. Some of the impacts of what's happening with these protocols is that when a CFO is trying to manage the cash flow of the company, they don't have time right now to effectively liquidate and manage the cash flow. So what they're doing is they're dumping coins into the market when suddenly they need to make payroll. They're, the bookkeeping and accounting for it is pretty questionable a lot of times. And then also just, there's a lot of uncertainty from a regulatory perspective. We've heard it many, many times where somebody has allocated a big chunk of their treasury to somebody to manage for them, and then they find out that whoever's managing for them doesn't have the proper licensing, doesn't have the proper registration. So suddenly, your money is being used for things that are violating regulations that you didn't even know that applied to you. So that's another thing where CFOs have to become regulatory experts before they can allocate their money out. And then oftentimes they have to decide between their incentive alignment. Do you want to put your money in traditional finance? Even though, I think everyone in this room's answer would probably be no. We don't, because we don't trust them. But sometimes, we do have to lean on that broader stability, which that sounded a lot better before the whole bank collapse in the US. But we do often have to decide between the trade-offs of putting our money with people we don't really want to succeed in the long run, and making sure that and by that I mean big finance who's taking advantage of retail investors, but versus the longevity of our team and how much we need in order to survive. So treasuries need comprehensive management. A lot of times when we talk to protocols and treasuries or small crypto-native companies, we ask them, what are you doing to manage your treasury? And almost always the response is, well, we work with a market maker. Well, that's just one tiny, tiny piece of what you need to do if you're trying to manage your treasury. Market making, and I'll talk a little bit more detail about that in a second, but market making is just one piece of it. You also have to have risk management. And by that I mean, a simple example of risk management would be, does your system or the system of the person that you work with tell you what positions you are holding at all times and how long it will take you to liquidate at all of them? Our system does that. So if we're holding 15 different tokens across 8 different venues, it's going to tell us to the minute how long we predict it would take us right now to liquidate everything that we're holding. And anything that's not liquid, that would immediately go to 0. So if you have a treasury allocated across multiple locations, that's some analysis. That's just some basic risk analysis that you should be doing at all times to make sure if there is a massive market event, what are you left holding tomorrow? And if you don't like that number, then you need to make sure you can make some adjustments quickly. or you need to work with somebody who's going to monitor that for you in real time. Cash management, that's another simple one. A lot of times we just get busy and suddenly somebody from accounting calls and says, hey, we need payroll tomorrow. You need to move money around, and suddenly somebody's out there dumping coins in order to be able to pay in cash, because other than Franklin, which does allow you to pay in stable coins, most payroll providers won't get anywhere near crypto, so you're going to have to liquidate in order to pay your employees in US dollars and your employment taxes. Liquidity management, that goes along with it. How are you getting liquidity out of your tokens? It should be a constant thing. It shouldn't be a, hey, we need money tomorrow, so let's just liquidate some stuff now. It needs to be planned ahead so that you're getting best price and best execution. And unfortunately, another thing that we see a lot is somebody will just say, well, let's just pull 3 months worth of payroll. And then they dump it into USD, and then they sit it in a checking account, and then that money is not put to work. And instead, it should be part of a full plan for you for liquidating and paying out your cash needs. And then all that's just part of optimum utilization of funds. You should have a very, very complicated spreadsheet somewhere that has all of the different pieces of your cash management and treasury management plan. Because if it's all just sitting in one account somewhere with a custodian, that's not a treasury management plan. So liquidation services. So one thing that we offer is continual liquidation. As I mentioned, you shouldn't be dumping stuff into the market in last-minute situations just because you need some cash flow for something. You need to have a full plan of how much cash do we need this month for operating expenses, what kind of a buffer do we want, what's our burn, and when is that going out, how much do we need to be liquidating to replenish those. You shouldn't be over-liquidating just for convenience, because price in these markets, especially if you have a really illiquid token, that's incredibly important. If you dump your token to make payroll because you didn't think about needing the cash ahead of time, you're going to impact your own project, you're going to impact your own price. So what we're able to do is do that continually, 24 hours a day, 7 days a week, to make sure that you can meet your cash flow needs for running your business. Market making. So market making, the biggest complaint we've got from protocols that we've talked to and the one that we work with is that they have no visibility into what's happening with their market makers. They don't know if the market making is happening in chunks throughout the day. They don't know when it's on which exchange. They just have zero visibility. So one of the things we've offered, and one of the things we're doing now for one of our protocols, is we do a non-custodial market making. So they create a sub-account, give us API keys, and we do the market making for them, but they have complete visibility into what we're doing at all times. They can see that we're not playing against them. They can see what we're doing across exchanges. So it's another big challenge for protocols that are using market makers, and there's a discrepancy between a centralized exchange price, decentralized exchange price. If your market maker is working for you, what they should be doing is making sure that there's adequate liquidity across both of those venues, or if you have a dozen or 2 dozen, all of those should have their liquidity balanced. But instead, what happens a lot of times with market making is they arbitrage the price difference, which is actually going to hurt you. It's going to hurt your token. It's going to hurt your protocol. And when that liquidity drops on one of those venues because of the arbitrage, you're going to lose users on that venue. And that's exactly the opposite of why you hire a market maker in the first place. And then subnet to mainnet liquidity, that's another thing that your market maker should be paying attention to. As more layers, as more layers develop and bridges and what we expect to see build out in the future, there's going to be more liquidity mismatches across different levels of this ecosystem. And a good market maker should be making sure they're managing for that as well, not just for the pairs on each individual venue that they're trading, but they should be looking at the whole picture, and making sure that it's all in balance so that your volume and your user base grows in every location, not just the profitable ones for them. Active asset allocation, we have active funds that we manage. We have a long-short momentum-based fund that we've been running for the last 5 years. We have a DeFi market-neutral fund as well. So this allows people to allocate part of their treasury or part of their balance sheet to actively managed capital. Again, you would work with us to determine the amount of risk that you wanted to take for an actively managed piece of your portfolio, and then allocate it across the 2 different strategies that we have. Passive asset allocation, this one is a little bit more of a hot button with some people. There are some protocols out there who absolutely want nothing to do with anything traditional, which I respect that. But others which have very, very large treasuries realize that they need to diversify outside of crypto, at least in the near term, until the crypto market has a bit more ability to sustain and diversify. I mean, as we all know, if one major crash happens, it takes everything down. And until that stops happening so much, we need to have other venues that are not crypto in order to put some of our cash flow away. Treasuries, commercial paper, even something as simple as a money market account. Anyone who has an SVB account should be able to get a money market account and be collecting 4% on your money that's just sitting idle there. And you should be sweeping that over only as you need it. And those are a lot of just very simple, easy things that we can set up and help you to manage your treasury for your passive assets. Premium harvesting and yield generation. So these are the highest risk things that you should be doing with your treasury. And this is where a lot of people get caught out. They get involved in lending and they, covered calls and the market turns quickly and they're not available, or they don't even have somebody watching it close enough in order to react. So there's a high amount of risk in this kind of stuff, but there's also a lot of return if it's done well. So any kind of full treasury management program should absolutely incorporate some of these features, but again, they're high risk, so you want to make sure that it's just a small allocation. But overall, to have a sophisticated treasury management plan, it's not going to happen overnight. It's not like tomorrow anyone's going to have the time to go out and implement all these things that I just talked about. But hopefully you can go and you can look at what systems do you have in place? Where is my money? Do the risk analysis that I was mentioning earlier, where you look at what you're holding and look at where you're holding it, and figure out if there is a flash event and I needed to liquidate my entire portfolio in the next 2 hours, how much would I get away with? And if that number isn't enough to sustain you for the next 2 years runway, then you need to really seriously revamp your treasury management plan. Because unfortunately, we've seen so many companies in the last year just completely go under. People, just had too much at risk and didn't imagine the scenario where over and over and over and over again we could see massive loss of value. I mean, I don't know about you guys, but I held a lot more personal wealth in crypto a year ago than I do today. And I even went and diversified my own personal stuff even more, and I thought I was pretty well diversified. So if you are holding a treasury for your company, think of it as holding the future of your company. That is what's going to pay the bills. That's going to be what pays for salaries. That's going to be what pays for, AWS if you're on AWS. That is the future of your company. And if you are holding it, you're holding the future of your company. And you need to make sure that the number one goal of that treasury is longevity. And so if anyone is interested, you can easily find me on LinkedIn. I'll be here all day. I'm happy to chat with you. And we have a lot of protocols we talk to that they're not our customers. Hopefully someday they will be. But we're always happy to share what we know. We've been doing this for 5.5 years. We've learned a lot of lessons. We've seen a lot of people come and go, and we'd like to see less of them go. We'd like to see this industry really, really grow and flourish and be what it can be. And for that, I just want to say thank you for your time. Thanks for listening.